Stocks just closed at record highs. So naturally, investors must be throwing money at equities, right? Not quite. In the week through August 5th, US equity funds saw $1.58 billion of net outflows, while money market funds took in $55.69 billion. The S&P is throwing a record high party, and a lot of capital is apparently still in the lobby. That does not mean smart money knows a crash is coming. It does not even mean the same dollars left stocks and went straight into money market funds. 1 week of flow data is a snapshot, not a confession. But it does expose an interesting setup. Index prices and investor participation can move in different directions. Look at the engine under the rally. On Friday, the S&P 500 closed at a record 7,757.64, up 0.62% for the day and 3.58% for the week. Through Friday morning, 85.1% of the 436 S&P 500 companies that had reported earnings beat analyst expectations, according to LSEG data cited by Reuters. Strong earnings, especially across major technology names, can keep a capitalization-weighted index climbing even when fund flows are less enthusiastic. The bull does not need the whole parking lot. It just needs the biggest engines running. So the main variable now is the return investors can earn by staying cautious. If Treasury yields remain high enough and inflation stays uncomfortable, cash and bonds keep competing with stocks. In that base case, equities can still grind higher, but the rally may depend heavily on earnings and leadership rather than a broad rush of fresh money. That is not automatically bearish. It is simply a market where the party outside and the waiting room inside can both be full. The bull case gets more interesting if inflation cools. July CPI is scheduled for Wednesday, August the 12th, and Reuters notes that Treasury yields are a major risk to this rally because higher yields make bonds more competitive with equities. If inflation comes in soft, yields ease, and equity participation broadens, some sidelined capital could decide that waiting is getting expensive. The waiting room door opens. That still does not guarantee a stampede into stocks, because money market balances do not mechanically become equity buying. The bear case is almost the mirror image. If inflation surprises higher, yields jump, and Fed hike expectations rise again, expensive growth stocks face stronger competition from safer yields. That matters because technology and semiconductors have been major drivers of this rebound. So the calm verdict is simple. Record highs do not prove everybody is all in, and a big week for money market funds does not prove a crash is coming. Price says confidence. Flows say caution has not disappeared. The next message comes from CPI, yields, and whether participation finally walks out of the lobby and joins the party.